Today, we're doing a complete breakdown of IAS 38. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying international financial reporting standards, prepping for a Big Four interview, or working in finance, this is everything you need to know. Imagine valuing a brand like Coca-Cola without clear rules. Intangible assets perplexed accountants until IAS 38 standardized their recognition and measurement. It ensures consistency in financial statements, reflecting true value. Viewers will grasp how this standard transformed the financial landscape, turning the intangible into concrete figures you can rely on. Prior to IAS 38, companies faced chaos in valuing intangibles, resulting in inconsistent financial reporting. This standard introduced a clear framework for recognizing and measuring assets like patents, ensuring comparability and transparency. By aligning intangibles with tangible asset standards, it brings clarity to financial statements, revealing true economic value. Since 1999, IAS 38 has required entities using international financial reporting standards to recognize intangible assets when future economic benefits are probable and costs can be reliably measured. This consistent application prevents valuation disparities, ensuring clarity and comparability in global financial reporting. The standard's adoption marked a pivotal shift, enhancing transparency across industries. IAS 38's recognition and measurement model demands assets meet specific criteria before recording. Initial measurement is at cost, with options for future valuations. Amortization applies to finite lives, while all assets meet impairment checks. This approach ensures precise financial information, crucial for investors and essential for acing finance interviews. Scope defines what IAS 38 governs. Candidates often mistake goodwill as included, a classic interview trap. Instead, it applies to patents, software development costs, and more. Understanding these boundaries ensures accurate financial reporting and avoids embarrassing errors during interviews. IAS 38 sets the stage for recognizing intangible assets like patents, trademarks, and copyrights. It also covers software development costs, crucial for tech companies, and franchise agreements, key in retail and hospitality. Knowing these inclusions helps in valuing assets accurately and aligning with global accounting norms. IAS 38 explicitly excludes goodwill, a classic interview trap. Financial assets and deferred tax assets are also out, governed by different standards. Understanding these exclusions is crucial, especially when aligning financial statements with international financial reporting standards. Misinterpreting these can lead to significant reporting errors. An intangible asset is non-physical yet valuable, like a patent or trademark. It must be identifiable, either separable or from contractual rights. Imagine a tech patent. It enhances company value and provides future economic benefits. IAS 38 ensures these assets are recognized, securing financial transparency. Recognition criteria under IAS 38 demand assets be identifiable, controlled, and expected to bring future benefits. For example, internally developed software must meet these before appearing on balance sheets. Accurate cost measurement is vital, ensuring reliability in reporting and compliance with global standards. Navigating IAS 38's scope can be tricky. For an internally developed app, it applies if criteria are met. Customer lists purchased? Beware, that's goodwill and excluded. Software licenses do fall under this standard, while internally generated goodwill does not. Mastering these nuances prevents costly misclassifications. Imagine a tech company investing heavily in software development. How do they report this as an asset on their balance sheet? The recognition and measurement model in IAS 38 provides a framework to recognize and measure intangible assets, ensuring transparency and comparability in financial statements. IAS 38's recognition and measurement model is vital for determining the value of intangible assets. We'll follow Meridian Corporation's journey as it signs a $10 million SaaS contract, including an $8 million software license and $2 million in implementation services. Each step ensures the asset is recognized and measured accurately, reflecting the economic reality on financial statements. In Step 1, Meridian Corporation identifies its 8M software license as an intangible asset under IAS 38. It's non-physical and identifiable, meeting the criteria for recognition. A common misstep is misclassifying intangibles, leading to errors in financial reporting. Remember, IAS 38 requires the asset to be separable or arise from contractual rights, ensuring it's properly recorded on the balance sheet. Step 2 ensures Meridian Corporation's $8 million software license meets recognition criteria. It promises future economic benefits and has a reliably measurable cost. A frequent mistake is ignoring the need for a reliable cost measure, which could prevent recognition. IAS 38 mandates demonstrable economic benefits and reliable cost measurement to validate recognition, safeguarding financial statement accuracy. In Step 3, Meridian Corporation records the $8 million software license at cost. This includes the purchase price and directly attributable expenses, such as implementation services. A mistake here is omitting attributable costs, leading to inaccurate asset valuation. IAS 38 ensures all relevant costs are included, setting the stage for accurate amortization and impairment calculations. Step 4 involves determining Meridian Corporation's $8 million software license's useful life. Estimated at 3 years, this aligns with the contract duration. Misestimating useful life impacts amortization and financial projections. IAS 38 permits a finite or indefinite useful life, emphasizing regular reassessment to ensure ongoing relevance and accuracy in financial reporting. Finally, Step 5 guides Meridian Corporation in amortizing its $8 million software license over the 3-year useful life. Annual impairment tests ensure the asset remains accurately valued on the balance sheet. Failing to perform these tests can lead to asset overstatement. IAS 38 mandates these annual checks, ensuring the financial statements reflect true asset value, completing the recognition and measurement model process. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. IAS 38 offers a cost model and a revaluation model, but both require specific disclosures. Knowing what must be disclosed ensures transparency, aiding investors in making informed decisions about intangible assets. Recognizing an intangible asset like a patent happens when future economic benefits are probable and costs are measurable. Initial measurement includes costs like purchase and direct expenses, recorded when the asset is available for use. While research costs hit the profit and loss immediately, qualifying development costs can be capitalized under IAS 38. Subsequent measurement of intangibles involves choosing between the cost model and the revaluation model. The cost model records assets at cost minus amortization and impairment. The revaluation model, possible only with an active market, adjusts to fair value. Regular impairment testing ensures asset values remain accurate, protecting against overstated assets on the financials. Intangible assets show up as non-current assets on the balance sheet, influencing the company's asset base. Amortization hits the income statement under operating expenses, impacting net income directly. Impairment losses need clear reporting, ensuring investors understand potential declines in asset value. Comprehensive notes reveal chosen measurement models and the nature of intangible assets, enhancing transparency for stakeholders. Key disclosures in IAS 38 include amortization methods and useful lives, which are crucial for understanding expense timing. Revealing carrying amounts helps assess asset values. Clarifying impairment losses and reversals ensures stakeholders grasp value adjustments. Any changes in accounting estimates must be disclosed, as they influence future financial expectations and investor strategies. Consider a CFO managing a tech firm's intangibles. Capitalizing $5 million in development costs boosts assets. Amortizing $500,000 annually over a decade reduces taxable income and affects earnings. Opting for the revaluation model, a $2 million increase in patent value demands thorough disclosure. An impairment trigger results in a $1 million write-down, shifting the perception of the firm's financial health. Meridian Corporation, a global manufacturing giant, acquires a patented technology for $1,200,000 to enhance production efficiency. Explore how this intangible asset is treated under IAS 38, from recognition to eventual derecognition, and see its impact on financial statements. This acquisition of patented technology is accounted as an intangible asset under IAS 38. By debiting intangible assets and crediting cash, Meridian recognizes this asset on the balance sheet. This reflects the expected future economic benefits from the technology, enhancing production and potentially increasing revenue. The $240,000 annual amortization charge reflects the cost allocation of the patent over its 5-year useful life. Under IAS 38, amortization ensures that the asset's cost matches its benefit period, impacting both the income statement and reducing the asset's carrying amount on the balance sheet. Impairment testing under IAS 38 revealed that the patent's recoverable amount is lower than its carrying amount. Recording a $150,000 impairment loss reflects the diminished value, reducing the intangible asset on the balance sheet, and recognizing the loss on the income statement, impacting profitability. The upward revaluation of $200,000 showcases the patent's increased fair value, which is aligned with IAS 38's revaluation model. This adjustment enhances the balance sheet, with the surplus credited to equity as revaluation surplus, offering a clearer view of asset appreciation. Post-revaluation, the annual amortization charge increases to $280,000. This reflects the higher carrying amount from revaluation. Under IAS 38, this ensures the amortization matches the asset's enhanced value, aligning cost with benefit, and affecting the income statement and accumulated amortization. Selling the patented technology for $950,000 results in a gain, calculated after accounting for its accumulated amortization and revalued carrying amount. This transaction under IAS 38 removes the asset from the balance sheet, while recognizing a gain, enhancing Meridian's profitability and liquidity. Every Big Four and investment bank interview on IAS 38 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. An intangible asset is a non-monetary asset without physical substance. IAS 38 requires it to be identifiable, controlled by the entity, and expected to provide future economic benefits. Common mistake: confusing intangible with tangible assets. Remember, trademarks, patents, and goodwill are key examples. For interviews, focus on identifiability and control as the core criteria. IAS 38 exists to provide a framework for the accounting of intangible assets, ensuring consistent recognition, measurement, and disclosure. It helps companies accurately reflect their financial position by recognizing assets like patents and software. Candidates often overlook its role in transparency and comparability. Remember, consistent application is vital for stakeholder trust. Under IAS 38, amortize intangible assets over their useful life using a method that reflects the pattern of consumption of economic benefits. Straight line is most common, but use diminishing balance if more appropriate. Many candidates incorrectly use straight line by default. Always align with usage pattern. This affects profit reporting. IAS 38 mandates that research costs are expensed when incurred, whereas development costs can be capitalized if specific criteria are met. Common error: capitalizing research costs. Key criteria include technical feasibility and intention to use or sell. Remember, only development costs meeting these criteria enhance asset value on the balance sheet. Indian accounting standard aligns closely with international financial reporting standards, but differences exist, like fair value revaluation and amortization methods. Indian Accounting Standard 38 allows revaluation only if an active market exists, unlike more flexible international financial reporting standards. Many candidates miss these nuances. Understanding these differences is crucial for roles in India-focused MNCs. Internally generated goodwill is not recognized as an asset under IAS 38. It lacks identifiability and control, failing the standard's criteria. A common trap is confusing it with purchased goodwill. Remember, only goodwill from acquisitions is recognized. Internally generated lacks a reliable measurement basis. IAS 38 requires impairment testing when indicators of impairment exist. using IAS 36 guidelines. Calculate recoverable amount as higher of fair value less cost to sell or value in use. Many candidates ignore impairment triggers. Key takeaway: regular reviews and sensitivity to market changes prevent asset overstatement. Imagine a tech firm spends $500,000 on development, meeting IAS 38 criteria. Capitalize this amount amortizing over 5 years. Initial entry: debit development costs $500,000, credit cash $500,000. Annual amortization: debit amortization expense $100,000, credit accumulated amortization $100,000. Candidates often stumble on capitalization criteria. Focus on technical feasibility and future benefits. CFOs must disclose the nature, useful lives, amortization methods, and impairment losses of intangible assets per IAS 38. Include revaluation amounts if applicable. Many skip detailed explanations of assumptions and estimations. Clear, comprehensive disclosure enhances stakeholder understanding and confidence in asset valuation. Confusion arises from the lack of physical substance in intangible assets and their overlap with tangible items like software embedded in hardware. Many mistakenly categorize due to similar economic benefits. Always check the asset's nature and IAS 38 criteria, identifiability, control, future benefits to classify correctly. IAS 38 sets the stage for accounting intangible assets, excluding goodwill. It applies universally to identifiable non-monetary assets without physical form. Control and future benefits are key. Entities must control the economic benefits, like revenue growth or cost savings. Recognition hinges on the likelihood of benefits and reliable cost measurement. Understanding these basics is crucial for correctly applying this standard. Recognition focuses on probable benefits and measurable costs. The cost model carries assets less amortization and impairment, while revaluation applies if active markets exist. Amortization spans the asset's useful life and less indefinite, necessitating impairment tests based on recoverable amounts. Disclosures must include methods, useful lives, and carrying amounts, offering transparency in financial statements. Watch for pitfalls like mixing asset lives, leading to errors in amortization. Unlike U.S. generally accepted accounting principles, international financial reporting standards permits revaluation with active market data. Disclosures must detail amortization and impairment. Active markets for intangibles are rare, complicating fair value. Subjective assessment of future benefits can cause inconsistencies. Stay alert to impairment indicators and use systematic methods for amortization to match benefit consumption. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos.